Despite all the headlines and volatility, we're still in a range bounded by the January 26th high and the February 9th low. The good news is we've recovered 79% of the distance from the bottom to the top of the range. This week, we almost cleared the March highs when Trump announced a list of $200 billion in tariffs on Chinese goods. The question we'll answer in this video is about the overall character of the market. Are we in a market bubble or a sideways market trading range in an ongoing bullish trend? The difference has a big impact on determining how the market handles the ongoing global trade war. We open with a summary of this week's economic data and interpretation. The economic calendar had important readouts this week on job growth, inflation, consumer and business sentiment. The U.S. economy remains incredibly strong, and the market showed resilience in the face of the most recent tariff announcement, with the Nasdaq hitting a fresh high the day after the announcement and the Dow closing the week back over 25,000. Now we'll look at our week in review, where we take a look at the headlines and how they move the market. The main themes in the market were the strong economy, expectations of strong quarterly earnings, and a prevailing sense that we have leverage in the current trade disputes. Conversely, trade concerns still weigh on the market, as does fear of an aggressive Fed and the yield curve. Looking at the headlines that move the market, on Monday, stocks rose on follow-through from the prior week's strong monthly jobs data. On Tuesday, stocks continued their rise on expectations for another strong quarter of earnings reports. After the close on Tuesday, Trump announced a new list of $200 billion in tariffs on Chinese goods, which caused the market to fall on Wednesday. On Thursday, markets digested the news, determining that we've not yet reached a tipping point in the trade dispute, and again at present it appears to be a dispute that we're winning. On Friday, tech followed through with a new, albeit weaker high, and the Dow closed above 25,000. For the week, we closed up 1.5%, and the monthly and year-to-date statistics are also provided at lower right. Now we'll switch gears and start looking at charts and patterns to answer the question, are we in a bubble or a trading range? The difference is the key to how the market handles events like the global trade war. The markets can seem random and frightening if you can't see and make sense of patterns. Let's start with this long-term chart of the S&P going back to 1925. You don't need any special knowledge to begin to see patterns. The first thing that jumps out at you is that price on the chart starts at the bottom left and goes to the upper right. Next, you notice that market tops, like 1929 and the 2000 dot-com bubble, can be connected with a line. You notice something similar with market bottoms, remembering that we've talked about false breakdowns that sometimes go through the bottom of the trend line. You notice a similar set of market tops and bottoms that run right through the middle of this channel, and it begins to look like a road. In the lanes on either side, you see other significant tops and bottoms that price has touched repeatedly in the past. The green line is now a support line, and the red line is the current resistance line. Patterns in the market are fractal, repeating over and over again on smaller and smaller time scales. If you look, you notice another smaller line of support here. Going back to the red line that was once support and is now resistance, it served as support here in 1999 and again in 2001 before it gave way and became resistance here, here, and most recently served as resistance here in January of 2018. Look at the green line. Once it was broken in 1970, it became a red line of resistance, and it was tested many times through the 70s and 80s until it was broken through again and became a line of support. So remember two things about this chart. First, prices moved to the upper right over a long period of time. And second, look at the red line again. The more times a line of resistance is tested, the higher the probability that price will eventually break through it. Now that we see that there are patterns on charts that can tell us about the probable path of price in the future, we're going to cover some slides from our May 11th video to understand how patterns are formed by supply and demand from buyers and sellers. If you wish to review this video, we cover the subject in much more detail. For our purposes here today, we're going to focus on how supply and demand and actions of buyers and sellers create patterns in the markets. When supply and demand are roughly balanced, price trades sideways. There are always many reasons to sell or reasons to buy. When the majority of market participants see more reasons to sell, there are fewer buyers and price goes down. Remember, this slide is from May 11th, 2018, and some of these reasons to sell have faded into the background, while others have emerged to take their place. When the majority of market participants see reasons to buy, there are few sellers and prices go up. Little supply and greater demand. Again, the reasons listed are from May. We'll add some new ones that are boosting the market. In particular, a growing force in a strong job market is investment in 401ks that are invested in stocks. Think about all of the millennials entering the workforce and the unemployed finding jobs again. In fact, we have the tightest labor market that we've had since the 1960s. All of these people are offered an opportunity to put part of their paycheck in a 401k. They're given an array of investment mixes, just like the one shown on the slide, and their money will be flowing into the market for a long period of time. So how do the actions of buyers and sellers create patterns we've seen in the market? To answer this question, we're going to look at a bullish consolidation pattern. Price in a bullish trend becomes exhausted, much like we saw in late January 2018, and meets supply from sellers. This can be investors taking profits or short sellers who have determined the market has gotten overextended. Price declines again until it becomes attractive to buyers. In a bullish rectangle pattern, the pattern repeats until sellers are exhausted. Price breaks up through the resistance line and the bullish trend continues. Buyers and sellers create similar triangle patterns in the market. Looking at the patterns on the left, when price is in a bullish trend, it enters the pattern from the bottom. We emerged from the 2015-2016 correction into the resumption of the bullish trend and corrected again starting in late January of 2018. We've been talking about symmetrical triangles for months now following the start of the correction. And we're also going to look at an ascending triangle pattern as well. Now we're going to switch from textbook patterns to actual patterns in the market. This is another slide from the May 11th video when we were talking about the symmetrical triangle pattern drawn in yellow. We'll add a legend for the actions of buyers and sellers that create the pattern and apply what we've learned. Supply comes from sellers in an overextended market each time the market peaks and buyers are overwhelmed with supply from sellers. This forms the upper boundary of the symmetrical triangle. Buyers are attracted by the steep sell-off and buy from panicked sellers, and more buyers step in to buy dips, forming the bottom of the symmetrical triangle. Patterns change over time as bullish or bearish price action unfolds. Patterns are used to determine probabilities, not to predict price. As you can see in May, we suggested that we were in a bullish trend and we were now consolidating. We recognized that price could break up out of the pattern or it could break down, but it would likely break up. And indeed, we did clear the 2650 level that we were watching in early May. Now we're going to look at a daily chart of the SPY, which is the S&P ETF, to put all of our patterns together and see if price is evolving in a bullish or bearish manner. Remember, a bullish trend is marked by higher highs and higher lows. We entered the pattern from a bullish trend and sold off. The peak and the bottom form the trading range that we've been in since late January. Within this range is another range that we've tested the top of multiple times since March until breaking above it this week. This chart was prepared on Wednesday of this week, and as of Friday morning, we're testing the top of this range again. Here is how our symmetrical triangle pattern from the May video played out. Remember, the symmetrical triangle is a sideways pattern, and we label the point as the apex. Price broke out above the triangle in mid-May and then retested the upper side in late May. The new peak in late May forms a new triangle with a higher apex than the previous triangle. The higher and higher lows since April and a new peak in June form a new symmetrical triangle with an even higher apex. We broke above this triangle in July and retested the top of it this week. Now, with the smaller rectangular consolidation pattern that we talked about earlier, we have another pattern that we said we'd talk about, called an ascending triangle, with an even higher apex if you project your lines out to the right-hand side of the chart. The significance of an ascending triangle pattern is that as we continue to make higher highs and higher lows, the more likely we are to break through this side of the triangle to the upside. Last, with a break above the ascending triangle, the pattern may become an ascending channel by leaving the line from the ascending triangle formed by higher lows intact and adding an upper boundary formed by the series of higher highs. Remember, a bullish trend is formed by higher highs and higher lows. We're still within the original trading range set in January and February, but the current price action, despite the worrying headlines, remains bullish. This is not an opinion. It is what we can see and observe on the charts. It could also change as new events unfold. If the global trade war, which is a significant concern, or any other set of concerns becomes great enough to cause market participants to sell, we'll see that on the charts as well. But that's not what we see now, and we invest according to the evidence, the trend, and when the probabilities are in favor of positive investment outcomes. Remember that market participants express all of their opinions on bullish or bearish outcomes by buying or selling, and the market sees all transactions. Understanding the economy, following world events, and understanding how events flow through the financial system to create investment opportunities is incredibly helpful as an investor. As Charlie Munger said, you can get paid to read the newspaper, but there's a difference between paying attention to daily headlines that make predictions and critically thinking about probabilities. To be a successful trend follower does not require you to be an expert in fundamental analysis, foreign affairs, or any of these other subjects. While this knowledge is immensely helpful when evaluating probabilities, it is harmful when used with hubris to make predictions. Success as a trend follower does depend on knowledge of charts and patterns, knowledge of human behavior, knowledge of probability, and having a proven model-based disciplined system of rules for investing and proper risk management. We asked the opening question about whether the global trade war was going to pop a market bubble or extend the trading range that we've been in. What we didn't look at is human behavior that causes bubbles. You've recently seen a bubble if you've looked at Bitcoin. Chances are you heard friends, relatives, and neighbors talk about it last year if you didn't see stories about it in the media, which also, by the way, are hallmarks of classic bubbles. Here is a chart of Bitcoin through November of 2017. This is a parabolic price advance that is a classic bubble. Price crashed soon after. This doesn't look anything like the current stock market. Now let's look at human behavior in classic bubbles as shown on the right. Looking at the chart, you have the phases above the time axis, the path of price in red with the stages of behavior, and the participants labeled across the middle of the chart. Now let's look at Bitcoin on the left from September 2017 through today. Human behavior is predictable and tradable, which is why the shape of the bubbles is the same, whether it's Tulip Mania, the South Seas bubble, or Bitcoin. Look at the correspondence of all the phases as compared to the chart at right. I'll add one more phase that is more obvious in this bubble and was also obvious in 2000 and 2008 than what is shown in the textbook example. We'll add that phase here, and it's called distribution. We see that before the market peaks, there's more volatility in price. As early adopters recognize the market is now overextended and has entered a bubble phase, and begin distributing their shares or their ownership to latecomers to the market who don't recognize the bubble. Distribution is the final phase before the market reaches a top and then crashes. For our last slide, we definitively answer the question and show that the market is simply in a range, not in a bubble, and price is gradually moving to the upside. Our job is to be home on the range, to focus on the message of the markets and the charts, to invest when the probabilities are in our favor, and to always be alert to substantive change in the long-term trend. This is the key to capturing trend-following returns over a long period of time, without the drawdowns of buy and hold strategies that left investors so badly burned in 2000 and 2008. The probabilities say we'll eventually break above the January 2018 high and go on to make a higher high. Our job in the present is to stay focused every day on the long-term trend so that we can grow our investments. To do that, we have to keep in mind probabilities, follow our disciplined rules-based model, and stay focused on the charts, and not to take rash action based on day-to-day headlines. The information in this video cannot address the specific investment objectives, financial situation, or particular needs of any viewer. The information presented is solely for informational purposes and is not a solicitation or offer to buy or sell any security or financial instrument. None of the information in this video should be taken as investment advice. Any opinions expressed in this video are subject to change without notice. Caliber Capital Management, LLC, or KCM, is not under any obligation to update or keep the information contained in this video current. KCM, its officers, employees, or clients may have an interest in the securities, related securities, or derivatives of the securities referred to in this video. KCM accepts no liability whatsoever from any loss or damage of any kind arising out of the use of all or any part of this material. KCM recommends that you consult with a licensed and qualified professional before undertaking any investment decision.